Good afternoon, everybody. What a boring Monday this is. Sorry for that. Not that I can control that, but welcome to Market Minds. Hope you all had a great weekend. And looking at the market today, yeah, it's up. S&Ps are up 30 points right now. The Nasdaq is up. What are we up now? Over 200 points. The Dow is the laggard, but really because you've got UNH, United Healthcare, getting smacked. Deere, a couple of the other ones getting smacked. But interesting is that market's up and vol is up a little bit. In fact, I've got the VIX on the screen here, and if we look at VIX here, we see the VIX is up a little bit, and I think that's just because it's been so depressed recently. We've got, the big news this week is Wednesday in the Fed, and as of right now, 98% probability that they are going to lower rates. So that's really not in question. What is in question is Powell, and is he going to start to shift now a little bit less dovish and more to the hawkish side? What does that mean? That means that all the projections that we had over the last few months about potential rate cuts in 2025, are those still on the table, or is that something now that that's going to be tempered? And the market is really pricing in now that is going to be tempered. In fact, let me show you here. Let's go to the CME Fed Watch tool. Here we go. Okay, so it's actually 99% now for potential cut on Wednesday. So, excuse me, when the headlines come out and they say they're cutting, okay, great, no big deal. It's that's what's going to happen. What it is really, what is Powell going to say, right? That's when the fireworks always starts, is when he starts his, at 1:30 our time, 2:30 Eastern time, when he talks about the decision, when he talks about moving forward. So this is the December meeting. But now let's go to the January meeting. Okay, the January meeting, there is only a 15% probability of another cut. Okay, 15% for another cut. Then we go out to, where did that just go? There we go. Sorry, guys. Sorry. Okay, then we go out to the March meeting, and there is where we have potential for another cut, at least that the market is pricing in right now. Okay, and that's almost a 60% probability of another cut in March. So the market, just a couple months ago, here's that 60% right here. The market just a couple months ago was saying, we might get 4 cuts in 2025. Now let's go out beyond March to May. Okay, another further cut. There's only a 20% chance of another cut in May, and then that just gets smaller and smaller and smaller as we move out. And you know why we've seen that shift so dramatically since the November meeting, really, since we got the cut last month, which a lot of people said, we really didn't need it. Why did that happen, everybody? Why did that happen? Anybody? Yeah, exactly. You know why? Because of this. Not really because of the election, Sandip, but because of this economic indicators. The economy has been incredibly strong and resilient. And so all of these eco data points that we're getting, that a lot of times we don't even understand what they are. They've got acronyms to them, names to them. We don't even know what they really mean. But that has added up to what? To a strong economy and not lending itself necessarily to lower rates. That, okay, and inflation, all of that progress that we made through 2024 has now flatlined and even just kind of started to uptick a little bit. And there's a lot of concern out there that the new policies coming in with the new administration is actually going to make inflation worse. Tariffs, there's a lot out there. Hi, Gloria. So that's why there's most likely, in my opinion, Powell is going to probably signal a pause after this cut on Wednesday. So, why is it so incredibly important to understand these economic reports? And listen, there are hundreds, right? Hundreds of them. But the big ones, the market movers, are really ones that we should understand. And when we put out our week ahead that you all receive on Sundays, and we have the economic report section there, we don't list every report that's coming out. We do list the ones that are typically market movers. Now, they're not all moving markets at the same rate, right? Some are what's known as an A grade. Those are the big ones like, the jobs report, non-farm payrolls, CPI, PCE. Then there's B reports, C reports, et cetera, et cetera. But we really should understand what at least the really important, the most important reports mean for the economy and for the market. So when we look at these reports, just like when we look at volatility, okay, just when we look at volatility, and actually let me bring in a chart here really quickly. Okay, this is just a random chart. This happens to be MSTR. Okay, but down here, there's two lines down here. Okay, red line and a blue line. The red line is thank you, Zora. Red line is implied volatility. The blue line is historical volatility. What's the difference? The historical volatility, in this case, the blue line, that's what's happened in the past. So that's just taking stock individual moves, or if we're looking at S&Ps or Qs, whatever it is, what's happened in the past and plotting that out. The red line, the implied volatility, is taking that data in the past, that historical data, and using that to make predictions about what's going to happen in the future. Okay, well, I bring that up because that is really what the set of eco data that we look at and we scrutinize all the time are really broken down into leading indicators and lagging indicators. Okay, the leading indicators, those are the ones that can help us predict the future, kind of like implied volatility. The lagging indicators is really just a review of data that's already happened, that historical data. Both are incredibly, incredibly important to the economy and to the market. So let's go through some of them here. Let's talk about leading indicators first. Okay, ones that help us kind of predict what's going to happen. Okay, leading indicators forecast where the economy might be heading. Okay, it's measurable data that can indicate a potential change coming up in the economy. Okay, this data, and we're going to go through the reports of which are leading indicators, which are lagging indicators, but the leaders, okay, they can give us highly accurate and precise information about if there's an inflection or a turning point in the economy. And it's all based on data that's related to different areas of the economy. Okay. Lagging indicators, as I just kind of talked about, those reflect things in the rearview mirror. Okay. They can confirm trends or changes. Okay. They are very, very useful for helping us gauge the general health of the economy, but they trail the price action of an underlying asset. What does that mean? That means we will see moves in the overall market. We see moves in a stock typically before those lagging indicators come in. So before that data comes out, the move has already happened. So let's first talk about these. Okay, let's first talk about these. Okay, what do you think these are right here? Leading or lagging? Okay, leading or lagging. This is consumer confidence, durable goods, the stock market in general, and retail sales. Okay, that's the four that are on here. Okay, do you think these are leading or lagging indicators? Good, I love it. The first two answers are different. That is perfect. That is perfect. That's what we want to see here. So, what did I just say about the market in general? Right? The market makes its moves. This should be a tip off to everybody. The market makes its moves, or a stock makes its moves, and then we get the news. Right? Then it's in the rearview mirror. So that's a leading indicator. Stock market is a leading indicator. Consumer confidence, which we will get this week, leading indicator. Retail sales, which we will get this week, leading indicator. Durable goods, leading indicator. These are all data points giving us the projection of what's actually happening now, not what happened in the past. So let's go through some of these. Okay. So there's two of the consumer sentiment or consumer confidence numbers that we really focus in on, which are really can be big market moving events. Okay. One of them we're going to get this weekend or this Friday, and that's the Michigan consumer sentiment. The other one is you might see consumer confidence by CB. That's the conference board. Let's talk about that one. Okay, let's talk about that one first. So that is a government index, okay, conference board. And they release their consumer confidence index the last Tuesday of every month. Okay, and all they're doing is asking consumers, what do you think about the market? Okay, what do you think about the labor market? What do you think about business conditions? So that's a big one. The market, though, quite frankly, seems to focus more, for whatever reason, on the Michigan consumer sentiment number. So it's labeled that because the University of Michigan actually publishes this. Okay, it's a bit more detailed and it gauges consumer sentiment about the overall economy. Okay, so increases here. What would make us, if you were interviewed, if the conference board or the University of Michigan called you up on the phone and doing a survey, and they asked you how you're feeling about the economy, how you're feeling overall, what kind of things would you respond with? Well, you'd respond about, how's the stock market doing? You'd respond about how is inflation doing? Right? And you would respond out about, are you positive? Are you feeling good? You can go out and spend money? Or is it the opposite? Those are the kinds of things that make up this data set. And it's really important. It's super, super important. In fact, I think it's a lot more important than many others, because they're asking, John Smith and Jane Doe all across the country. So you're getting real boots on the ground information. Okay, that's a leading indicator. Retail sales, which we get this week as well. Okay, it's exactly what it sounds like. Exactly what it sounds like. It's a monthly report. Okay, and really, it's an indicator of how you and I feel about the economy. Okay, if we're feeling good, we're going to be spending more money out there. If we're worried about the inflation or about inflation levels or whatever it might be, we're not going to be feeling good. That number is, going to change based on our opinions. Okay, so that's retail sales. Durable goods. Talk about durable goods. Okay, this kind of shifts from the retail side to the industrial manufacturing side. Okay, so this is manufactured items, both from businesses and consumers, that typically aren't replaced in 3 years. Think of things like washing machines, refrigerators, those sorts of things. Okay, this report comes out at the end of each month. If we see an increase, okay, in durable goods orders, again, what does that mean? It means people are spending, people are confident, right, about the economy, confident about their situation. We see declines, means people are pulling back. So durable goods are really, really important. Understand durable goods, though, is not the same as going out to dinner. It's not the same as retail spending. These are typically the bigger ticket items that last 3 years or more. Okay, so that's why maybe when a durable goods report comes out, maybe that affects a stock like Whirlpool a lot more than it might affect another stock, because Whirlpool is putting out appliances, for the most part. Okay, durable goods. And then the stock market, obviously, that is a leading indicator. Okay, stock prices are based on what companies are expected to return. Okay, so market has been going, for the most part, up, up, up. We've stagnated a little bit, but listen, we're trading near highs right now. That's a leading indicator for economic reports. Okay, let's move on here now. We obviously just covered some leading indicators. Now we've got to do some lagging ones. Before we do that, here we go, guys. There's our word of the day. There is our word of the day. Okay, econ. Econ. I actually just started, speaking of econ, I actually just started a master's program. Yes, I am studying to get my master's at my age, and not because I'm looking to get another job or anything, but just because I am fascinated with economics. So I'm just finishing up my first class, which is behavioral economics, which is very, very interesting. But all of this plays into the decisions that we make on a daily basis. Okay, let's go to some of the lagging indicators now, guys. Okay, let's go to the laggards and then we'll come back. So these are some of the biggest reports that come out there. In fact, when it comes down to the Fed making decisions, okay, these are maybe the 4 biggest ones that they look at. But what are they making their decisions on? They're making their decisions about what's happened in the past. That's always baffled me. When you hear, and I'm sure Powell's going to say it on Wednesday, he's going to come out and say, we are going to be data dependent, right? Well, this is their data dependency. This is their data dependency. Things like PCE, okay? personal consumption expenditures, NFP, non farm payrolls, CPI, consumer price index, PPI, producer price index, GDP, gross domestic product, all these things, these are rear view mirror, but they are what the Fed hangs their hat on to help them make decisions. So let's go through these. Okay. The first Friday of every month, we get the jobs report. We do get weekly data as well on Thursdays, but the big monthly non farm payrolls report is on Friday, first Friday of every month. Okay. And it's exactly what it says. Non farm payrolls represents total number of workers employed by U.S. businesses, excluding farm workers. Okay, excluding farm workers, private household workers, nonprofit organization employees, military, and certain government agencies. Okay, big number, right? We know that we see the market move typically really big on non-farm payrolls. Okay, and how has this worked with interest rates and inflation over the last few years? Well, when we've seen an incredibly strong market, meaning that jobs being created, high numbers, that means the economy is really moving along well, and the Fed has to put some brakes on the economy. What does that mean? That means they're raising rates. You got to slow the economy down. And when we see that non-farm payroll number start to decrease and the labor market not as strong, okay, that's what the Fed's looking to get under control. That's when they can start lowering rates because they want to help start to accelerate the economy. Okay, so that's NFP. PCE, personal consumption expenditures. Monthly number. This is the one the Fed looks at the closest to help them decide where inflation is headed. Okay, and it reflects a change in the prices of goods and services that are purchased by all of us. Okay, and it's part of a report that takes CPI into account. Okay, but it's more encompassing than CPI. Okay, it comes out later in the month than CPI does. Okay, and it includes different weights that the government assigns to different categories, and it's different calculations. It dives deeper into the economy. That's why this is their preferred inflation measure. Okay, CPI, which we just got last week in addition to PPI, important also, but it's a monthly measure of the prices of a specific basket of goods and services. Okay, it does include food, transportation, energy. Okay, but again, what is it? It's what happened last month. Not predicting what's going on in the future. It's what happened last month. Now, there's CPI and there's core CPI. Core CPI excludes food and energy. And the reason that we look at core CPI as well is because food and energy can really be volatile month to month. Okay, so that's CPI. That's on the consumer side. PPI, which we also got last week, that is on the producer side or the seller's side of things. Okay, so it's tracking changes in production, inventory levels. Okay, and so even though CPI might be a little bit more closely watched, it's really PPI, right? Because if I'm a store owner, if I'm a producer, I gotta know what the consumer is doing out there, so I can gauge effectively how much of maybe a product I'm going to produce. Okay, and then GDP. GDP, everybody looks to GDP, but that also is in the rear view mirror. It's a lagging indicator. Okay, it measures U.S. well, not just US, GDP of any country, measures economic activity. When GDP increases, it's the sign that the economy is growing. When it contracts, okay, when GDP goes down, things are slowing down. Okay, some others also. Okay, those are the big leaders, the big lagging indicators. There's other ones though, and these might fall into like the B class that I was talking about. ISM manufacturing. Okay, it is a really key indicator because it indicates the level of demand for products. Okay, really that can greatly influence investor and business confidence. When you see, thanks, Bobby. Maybe, I don't know. I don't know. I'm not going to argue with them. I just sit back, take it all in. I do my assignments, ask questions when I need to. So that one's measured. 50 is like kind of the baseline for ISM manufacturing. However, the formula works that they put together, and I'm not going into it. If we see a number greater than 50, it means that the economy is expanding. If we see a number less than 50, it's contracting. Red Book. Okay, Red Book, which we'll get, I believe, tomorrow morning. Okay, shows a change in same store sales growth. It's a weekly indicator. Okay, but again, this is showing us retail sales. So this is an extension of what is the consumer doing. Okay, we got final call. Here's the final call, guys, for econ. Get your name in there. Get your name on the wheel today. Get your name on the wheel. Okay, so we've got Red Book and we've got Beige Book. Okay, Red Book index, by the way, was named that because there's actually a company, Red Book, that publishes this index. Okay, the Beige Book, okay, that is a government publication. Okay, and that one, it shows us the change in regional economic conditions. So we're the country's made up economically of 12 different regions, 12 Federal Reserve districts. Okay, I can't name all of them, but you see the New York numbers, Philly, KC, Chicago, there's 12 different regions. The Beige Book, which comes out 8 times a year, kind of odd that they wouldn't make it monthly or quarterly, but comes out 8 times a year, shows us the change in region by region. Okay, and then Jolts comes out also the first week of every month. Typically, it's either Tuesday or Wednesday ahead of the non-farm payroll report. This is a big one. This, in my estimation, should probably be up on the A list. Okay, what it stands for is Job Openings and Labor Turnover Survey. And what it does, it basically tells us how many job openings are there each month, how many workers were hired, quit, laid off. Okay, and it is a major component also of what the Fed looks at for the health of the labor market. The more job openings there are, okay, the more job openings there are, which there have been, okay, that's a sign of a really strong economy. A really strong economy. Okay, your business, they're expanding. They need to hire more people. Think of it that way. The less job openings there are, that's a contraction. The Fed wants to see that JOLTS number come down a little bit. They want to see the labor market cool off a little bit. All right, guys, that is obviously not all encompassing of every eco data point that's out there. However, those are really the ones, in my estimation, you should at least have a little bit of knowledge about. Understand that, you turn on CNBC, Fox Business, whatever in the morning at 7:30 Central is when many of these reports come out, 8:30 Eastern. Say, oh man, CPI this morning was X. What does that mean for the markets? Basically, everything comes down to the health and the strength of the economy, the health and the strength of you and I, the consumer. Market moves from there. That's what I got for you, everybody. That is today. So, with that, oh, this is a full wheel today. This is a full wheel. And I got a couple emails over the weekend, actually, everybody saying that if someone wins in a week, they shouldn't be allowed to win again. I kind of agree with that. I don't think anyone here is probably going to disagree with that. So we're going to start with a clean slate right now. Whoever wins today, okay, you can't win again. So Robert DB, you're out there. You can't win 27 times in a week, even though we only do 5 times. All right, so hopefully nobody has a problem with that. There's only so much swag we have to give out anyway. But all right, here we go, everybody. Let's give it a whirl today. Chris G, Eric Zelmer, Derek, Nico, Derek. Derek, are you here? Derek and the Dominoes, are you here? There he is. All right, bingo, bango, bongo. You know what to do, man. And you know what else I'm going to ask of you? If not just you, Derek, everybody. If you've already won, and when you shoot me the email about size and where to email or where to mail and everything, let me know what you may already have. I don't want to double up with you. Okay, I want to get you some new and different swag. Don't want to double up. All right, guys. Tomorrow I'll be back down on the trading floor. I'll be live on the floor tomorrow. Oh, look at Manish trading MSTR at 2.25. Nicely done, Manish. All right. Thank you, Gloria. I appreciate that very much. I appreciate that. All right, everybody. Have a wonderful rest of the day. I hope the afternoon is a little bit busier than this morning was, but boy, I think people are just waiting now for Powell on Wednesday. Anyway, have a great rest of the day, everybody. Take care.